Okay, we're now recording. So Karl, thank you very much for being with us today. And so just a bit about Karl. And Karl, I'm going to let you introduce yourself as well. But of course, in terms of you being the principal of the Cerebral Capital, fund that's there, that's one that I understand is a primary role for you. And also, if you could explain a little bit more about your role with the Shaughnessy Group, that would be really good. So Karl, thank you very much for joining us. And you've been doing investing for some time, so I'm going to ask you to do a very quick introduction on yourself.
Certainly. So I'm the child of immigrant Canadians. Migrated to Canada in the early 70s. My parents on both sides, my father's family and my mother's family, were all entrepreneurs. Arriving in Canada, they were entrepreneurs once again. And growing up in that experience, I kind of swore off entrepreneurship, seeing that as a child growing up, think that's just too risky. And also, for the first 20 years of my career, I worked in corporate environment. And after having enriched a lot of my bosses in the 7-8 figure range, I thought, maybe this entrepreneur thing is worth a try. So in early 2002, we formed the Cerebral Capital and started funding some different ideas and looking for different ideas. And we stumbled upon, as so often is the case, our venture in 2004, and that was a small business that was owned by a group. They weren't happy with the performance after 10 years of ownership. They asked me to take a leadership role. This was a very small business. I mean, I could put the whole company in my minivan for the first company Christmas party and drive to the restaurant. If we would have had an accident, the company would have been done. But I come from running public and much larger corporate companies, my last being one in Europe, that had about 170 people. So this was a very small business. And the challenge was really, this is a 30-year-old company. And I kind of looked at it as a 30-year-old startup. And we grew that business from $4 million to $225 million by 2017 when we exited that business. And started to look for our next new thing. For those of you that are serial entrepreneurs, it actually is a habit. It's not just something, it becomes a vocation. And we formed the Shaughnessy Group in the fall of 2017. My whole career and all of my colleagues' career has always been in credit, corporate finance, commercial finance, and not only providing capital and finance to other people, but also operating companies that provide capital. So we had always seen that the lower, what we call the lower middle market, companies that are reasonably sophisticated, but too small in size for Bay Street investment bankers, are often ignored. So our niche was to provide financial services, advisory services when it comes to selling their business, recapitalizing businesses, restructuring them, refinancing them, raising capital, and all those sorts of things that middle market companies need as well. And that's the purpose or mission of the Shaughnessy Group today. We have my partner in Vancouver, another one in Montreal, and we provide really coverage of the lower middle market in Canada as an ignored niche needing those services. Then through the Cerebral Capital, I'm also involved as an angel investor through some angel investing groups. Initially, I got introduced to this in Vancouver. I went us relocating back here after 13 years out west. I've been involved in the angel community here in Ontario. I'm on the selection committee of Angel One, which is a group of angels out of the sort of Burlington area. We recently merged and created what is called Equation Angels, bringing together now 4 angel groups in southwestern Ontario. So we have over 200 check signing investors constantly looking for new ideas and new startups to invest in. I remain on the selection committee of that as well. And that's how I got in touch. I guess the other thing, I went back to school and got my ICD designation to be an expert board member. And actually through that, I met an acquaintance of Gray's and I, who introduced me to what wonderful stuff that Gray is doing, and that's how we met, and that's kind of how we are here today. So I'm looking forward to this.
Thanks, Karl. So in the midst of that, there's some interesting questions. So would you say that your experience working with that firm was what really inspired you to create more involved with the kinds of things that you've been doing over the last few years here? Is it that transition where you grew that company from, you said it was from 2 to how much did you?
Yeah, 4 to 225. And I'd done that. I had been a corporate guy who took ideas inside corporations and created businesses from them within those corporations. So whether it was in the 80s, now some of the technologies that I can talk to you about, some of you will actually say, what is that? I've never heard of that. That's how quickly some things have gone obsolete. But building my first business from scratch inside a corporation from an idea to a $7 million business. When I moved to Toronto, taking an idea from $5 million to $400 million. When we went to Europe, turning around a $165 million business from not sustainable to highly sustainable and in fact more profitable than the parent. And throughout of that, I learned that really business is it's really like school. It is learning all the time. You're constantly learning, and you're always teaching and mentoring and coaching those that you need to partner with to be effective in your role as a leader. So whether it's corporate, internal, sort of corporate venture capital startups, or new ideas or new offshoots or spin outs or startups, I've always been a mentor to the folks that I support. And I was introduced, I guess it's more my nature, again, not by design, just by nature, that kind of mentoring role. I probably one of the proudest things is to look around in certain industries and see all the leaders in that industry and know that, they started their careers originally on my team. So that's what continues to inspire me. And that's really what attracts, I think, also founders to me. They go, well, this guy's been there and done it. He's gotten his hands dirty, lived through it. Maybe there's some value in some of the, bringing thoughts and ideas to me. So since 2017, we've got a portfolio just around a dozen organizations I'm working with, startup founders in all various stages, both in the West Coast and here in Ontario. And then through the startup community, you're constantly being introduced to other startups that need help in some fashion or another. And if I can be of service, I just enjoy doing it.
Thanks, Karl. Some of the things that you've been sharing with me are things that I think that this particular audience would be very intrigued by. You've been taking and distilling, I would say, your experience and crystallizing that into a series of questions or steps or stages, I guess you could say, key parts to how this kind of thing works. And with that, there's some things that I think relate. So first and foremost, there's been, you had said, an interesting experience with a CEO of a startup who said, well, there's not enough money. I got plenty of ideas. I can innovate like crazy, but there's not enough money. And my chase is after the money. I just, and you responded back. And you have a different perspective than that CEO was all about, saying, oh, we got to chase the money. And it's from there that I think a lot of the other pieces kind of fit. I think you might agree. So I'm going to ask you to expound a bit on that. So what is your view about what CEOs of corporations really need to know when it comes to like investors?
Well, what's interesting, the reason I paraphrased that when we had that conversation, Greg, was because I was getting that question or that statement with a question almost every week when I met with folks. I'm just looking for money. We're high energy, we're committed, we're focused, we've got a great idea, we've got a great product. We're just looking for money. And what I really saw, there was a bit of a disservice that, and to speak with some deference to incubators and accelerators, they do a great job teaching you how to pitch, but they don't talk investor, the language of investors. When in my last business, we raised over 800 million to fund that business and that growth over almost a 13-year period. We had to learn how to talk to investors. No matter how amazing the opportunity in the market was, we had to learn how to talk to investors. Once you understand how investors think and you can empathize with the investor from their perspective, you'll start to speak differently about your idea and about your product. You'll start to realize there is more to it than a better mousetrap. There is more to it than just the opportunity. Because the investor is inundated with all kinds of ideas and opportunities all day long. So what is going to make you stand out as different, and different better, not different worse, is having empathy to understand how the investor thinks and how the investor looks at your business, and then shortcutting that, making it easy for your investor to translate your pitch into something that they consider investable. When you're able to effectively do that, raising capital becomes not difficult, but finding great ideas for you to attach yourself to, it becomes the real value here.
Thanks, Karl. The other part to follow up on that, because I think a lot of pieces flow from that. So part of that, I'm thinking about the kinds of things where people's headspace might be in terms of when they're in the hub, things that they've been familiar with. They've gone through things like, doing a business plan. They've gone through value propositions for their customers. And a lot of it is customer and client centric in terms of, well, gee, this is what I'm trying to do for my customer. And so this is why it's valuable to them. And this is how I'm going to, get, money for that. So they begin to get their head wrapped around that. But with an investor, it's a little bit different, right? It's not simply about that. It's not quite the same as what they're doing with their customers. How do these pieces, how would you frame that in terms of how an investor looks at that aspect of things?
Maybe something I've heard people say is, better in a B plan and an A execution than an A plan and a B execution. The investor is all about execution. So to be able to articulate the fundamentals of your business and succinctly convey that is often the challenge, because we are so enamored with our idea or our product or our solution that in a lot of investor pitch decks, we see a large portion of the pages dedicated to the idea, the prototype, and how fascinating and how wonderful and how much better that is. But you forget the fundamentals that the investor cares about. And so you're speaking a different language and you're not connecting.
So to expound on that a bit, what is kind of the right language to speak then?
Well, very quickly, we it seems almost, it goes without saying that you have to have a good idea. However, it's not enough to just have a good idea. Um, what makes an idea a good idea is not because it's the first time I heard the idea that I have a good idea. It's when I go to research and check out my idea and find out that if I create this or if I do this, this is not easily copied or emulated by others. If I do a quick internet search, I don't find pages of other organizations doing the same thing. And often we get groups coming in to raise and ask, and we do a quick Google search and have 3 pages of other people doing the same thing. So what makes it a good idea is that it's not too many, not others are doing it, and it's very difficult to emulate. The expression that people say is you need a moat around your business. That is defendable differentiator that you need to develop over time. That creates a barrier to entry. That's all. Those are all things related to a fundamentally idea that isn't what something everyone else is doing. In that regard, right? And if you think about the pandemic that's underway right now, it's the businesses that are very, very easily copied, that are usually very small, that have lots of rivals, that are struggling the most.
Let's talk about that a little bit. So, in the standpoint of my understanding of things that you look at, you're looking at risk of various kinds when you're working with a startup, and part of that you just touched on, I think, in terms of there's a risk of being, well, simply not being strong enough to be able to be competitive enough. I guess you'd call it a competitive risk. Is that the term that you'd apply to that?
Yeah, so the investor looks at, he or she has their capital, and there's an opportunity cost to deploying that capital. So the risk is if I deploy the capital in the wrong, allocate capital to the wrong idea, I can only allocate it once. So the idea, there's a risk that the idea isn't a good idea. There's a risk that, first thing we start with is generally that the founders themselves aren't a strong team, because we're always betting on the team. So that's our first risk. So do the founders have the experience? Do they have the expertise? Do they have the education? Do they have, where are they? Have they done this before? Is this their first time? Have they worked together before? Is this their first time working together? All those are execution risks that we're concerned about. And you can get a higher mark or a lower mark depending on sort of in a continuum of have never done anything with no experience to done a lot of things, lots of experience, lots of track record, and lots of success. So that's why serial entrepreneurs who've done a few exits can raise capital just by word of mouth almost, where when you're just starting out, you've got to pay your dues because you just don't have the track record as an individual and as a founding team. So that's the first risk we deal with. Then the second risk we talked about is the idea itself unique, or are other people doing it? Then have you tested the idea? So you don't always need to build it completely to see if they will come. If you, depending on the type of, it's a minimal viable product. Sometimes you see this in the e-commerce space. The nice thing about e-commerce is I don't have to, unlike a traditional retail, I have to actually stock my store with goods and hope people will come and buy my goods. E-commerce store, I don't have to have any inventory. I just have pictures of the things that you could buy from me. And I don't need to buy the goods until people buy them from me. So setting up an e-commerce site with no inventory behind it is a lot less risky than renting a store in a commercial space and filling it with goods. So prototypes help to validate and test, are you going to get people interested in what you're doing? Are people subscribing to your product or service? Those are sort of like, think about it, you know, dipping your toe in the water versus committing completely and jumping in as an investor and even as a founder in your idea to validate your idea. Are all risks we have.
As an angel investor, that's the point that you like to focus on, is at that particular point from?
We generally come in after some other stages. So, for example, have you started to sell your product? Meaning, are people exchanging their hard-earned money for your product or service? Then that's what we call traction. Prior to that, you know, depending on your business model, that's all nice to have and interesting and important in your journey towards revenue. But seed investors are there when you already have prepared the soil to plant the seed to get the growth. So we're there in early traction as seed investors. So the founders initially invest their sweat equity, some of their own money. They have to convince each other that they're a founding team. And sometimes that is difficult. We get organizations where it's a single individual with no team around them. Like if you are not able to convince 2 or 3 other people to be as crazy as you about your idea, to throw their lot in with you, you're probably not going to convince anyone else either. And if those 2 or 3 or 4 individuals then develop something, and again, there's their own time and money, sweat equity. There are a lot of government grants these days that are available if you need to develop some sort of product that you can access. There's competitions you can enter to get the initial cash, sometimes if you're developing something more sophisticated. And then you need to be able to convince friends and family to chip in. All of that takes, you know, you're not going to approach your friends and family with something that you are not completely committed to. Those are all tests that are important to show how committed and convinced you are and how committed and convinced others are in your idea. But ultimately, it's when an independent third party is willing to exchange their cash for your idea. That's traction. That you really have now a validated product and a validated market for what you're trying to do. So it's, you know, you're just at the cusp of product market fit if you think about it in stages, right? So there's initially there might be customers who are trying your product on a trial basis. There might be free subscribers to your product. You may have visitors to your website ordering something, but you can't fill the order. That type of activity. You see it in all kinds of traditional businesses too, right? People will have coming soon in front of their coffee shop or their restaurant.
Yeah.
See if people care.
In terms of some of this, we have, suppose that people have done a number of these steps, that they have tested their toe in the water, so to speak. They have their MVP or bits of that put forward. They have some sales that are happening. They have the initial steps that are kind of coming forward there. How important do you think it is for the investor to help that startup by creating, say, new relationships, by looking at how they can become more, say, strategic in the marketplace, by introducing them to new players, new avenues, or opening new doors? Is that a key part to what it is that you do?
That is always important that's a very good point, because some investors only bring money and others bring relationships as well. So, they may be able to introduce you to somebody or an organization that could be a great partner to your business. That is often even more valuable than the amount of money that the angel might invest in your business, is the introductions to other relationships that can generate more revenue. So in most of the angel groups, that is part and parcel of what the angels are there to do. If you think about, you are nurturing this business like a newborn, right? And there's a lot of fussing about it going on by you. The angel can contribute. Think about the angel sort of like grandparents contributing to a newborn, right? They're going to help you out with more than just money if they're good angels for the space. So it's important that they have industry experience or can have the Rolodex or LinkedIn contacts, put it in 2020 terms, that they can leverage to introduce your business, your idea into their relationships.
Given that, I take it that this is kind of the way that you like to work yourself. You like to work with those kinds of businesses that you have the network and the connections to be able to help grow. Is that accurate?
Yeah, because again, it takes risk out of the equation. If it's an industry that I have no experience, that I've never been involved in, the only value I can add is my value is limited. But if I know the people you're trying to sell to, or the companies you're trying to get distribution through, or the partnerships that you're trying to strike, or access to suppliers that you're not able to reach in the supply chain, then adds more value to your business, but also increases my potential for a return as an investor.
Is there an example that you can share with us of some of the startups you worked with that's been, what you've done without, breaching, confidentialities and things? I mean,
well, in my previous life, we provided financing for tutoring, for K-12 tutoring. This particular company had developed a artificial intelligence technology that they were targeting to the education sector, but they were to the private education sector and specifically to tutoring. And the product is very simple. Nowadays, K-12 students are all using text messaging. And this is a company out of Waterloo. They developed artificial intelligence that allows you to take your text messaging app and interact with the AI and ask questions of the AI. And the AI will work with you and really answer the questions back and go through a process of teaching you how to derive the answers yourself. So because I've been involved in financing the education sector in Canada, the private education sector, most of the CEOs of those kinds of companies were already in my network. So it was just a matter of, introducing the CEO of a startup to those, which without those contacts, they would have started, somewhere lower in the food chain and taken months, sometimes years to make those kinds of contacts. So your investors can give you your idea credibility because they have embedded it already.
so what would you say are the primary areas? I mean, I take it that education is one. What are the other areas that you particularly are keen about?
I'm predominantly focused in financial services because that is where most of my experience has been. Now, having said that, I have financed so many different industries that I've had to learn how those industries work and how those business models work. So my major area of focus is financial services and technologies related to empowering or enabling financial services. But again, having provided capital and financing for 3.5 decades, both in Europe and here in those sectors, and really that's what we're doing at Shaughnessy Group, is working with established companies in recapitalizations or additional capital raising. That's generally where and again, in Canada, I find it hard as an M&A firm to be industry focused, because just any one single vertical generally isn't big enough to build a business on in that regard. But look through some of the, a very diverse portfolio of organizations that I'm working with at this point. Education, you wouldn't initially look at my profile and go, well, he knows about education. It just happens to be that we financed education, right? So it's not always immediately obvious when you meet someone where their life experience or business experience has been. Just because you look at someone's LinkedIn profile and it says they work for the really big Canadian bank, unless you know what sector within the bank, maybe they worked in agriculture, they worked in manufacturing or distribution or whatever, they may have all kinds of contacts that you never realized because that align with you. So you need to really interview and select both advisors and angels or investors for the best fit.
Yeah, okay. And that makes a lot of sense. And in terms of things, I'm about to ask our audience here to also start filing questions in on things. So Helen has started, Natalie has started. But please, do add your questions in chat. We'll be turning to those in just a second. One last thing I wanted to ask, or it's not necessarily last, but like a key piece, right? A key piece, I think, is why startups might not want to work with an investor. So I think there's a key part that's in everyone's mind when they're in the hub. And it's one of those questions they ask and they answer. Each and every one of them asks and answers that question one way or the other. Are they going to be open to taking investment or not? Are they going to do the opposite of that, which is more like bootstrap, which is still maybe taking investment of a certain kind, but maybe it's the friends and family sort of thing. It's not working with someone like yourself necessarily. Is there, in your mind, is there a set of questions, maybe 2 or 3, that would establish or help people to clarify, really, do they want to work with an investor, or is this something that they really don't want to do?
Well, I think there's a couple of different ways. So, for example, if what we investors call, some businesses we call lifestyle businesses, they will provide for you and your family a nice lifestyle. And there's thousands of those, millions of businesses there's 1.2 million businesses like that in Canada that provide a nice lifestyle for those entrepreneur owner-operators. Investors are looking for outsized returns on that. So by virtue, if your business requires capital to scale, and your idea is really unique, and is feeding into $100 million plus market, and you could be building a $50 or $100 million plus revenue business, it's very, it's pretty unlikely that you will do that without outside capital. But if your vision is a less than, $5-10 million business and it's really a lifestyle business, then yeah, friends and family and work off your cash flow is great. The problem is that the return on, there's a fundamental formula, it's called the DuPont formula. The return on capital of any business it lets you know how quickly you can grow. your business. So if the return on capital has of course to exceed the cost of capital for it to be a value-adding business, but it's very unlikely to see 20, 30% return on capital in the business in this day and age. Even if you look at companies that look like a company like Microsoft from its 80s forward, the return on capital required it to take outside capital. It's probably one of the exceptions that it took very little outside capital because it had so much return on capital in its business. But if you look at traditional industries, the return on capital is so low that you need, if you're trying to grow faster than the return on capital, you need outside capital or you're going to go insolvent. It's just mathematically not possible.
Right. Yeah. So some ideas require, yeah, for sure. And there are a lot of other parts that I'd like to ask, but I'm going to, for the moment, turn to the audience who have some questions here for you. And then maybe there'll be a few other things I might ask you towards the end. But Natalie, are you online here?
Yes, I am.
You were the first to ask a question here, and you've been most patient. That was about 5 minutes ago now. So thank you very much. You have a question here about hiring somebody to build artificial intelligence. So you want to ask Karl your question, set the context for him, please?
Yes. So hi, Karl. Thank you for your time today.
Yeah.
So my question is regarding like next steps. So I have an idea to develop AI for mental health, and I want to pitch it to the Ontario healthcare system. To develop this idea, even though I have physician support and even though I have some people who have experience in computer science, it requires funding. It requires funding to hire someone who could build the more complex AI aspects. And so while there are opportunities to pitch and apply for government funds, should I continue on that basis until I have enough money to pay someone to consistently build a prototype and then test it? Or should I just stick to should I do an angel investment? I know that you're saying that normally you want to see the prototype tested already, but we haven't found someone who we can afford to pay to build this technology in full and test it at the hospitals. So that's sort of where we're at right now.
Let me ask a question. Can I ask some questions, clarifying questions about your business?
Yeah.
So who is all on the founding team of this business?
Uh-oh. We might have a technical difficulty here.
How many is it you?
I think Natalie's gone. She has a problem sometimes with her Wi-Fi. So I'm not sure if she's not experiencing that.
All right, so maybe without knowing the response, my reason was that if you're the founder, then and AI is critical to the business, you should have a co-founder that is that so-called AI expert.
Absolutely right. Yeah.
And he or she is willing to put their sweat equity into this as much as you are. If you can't find someone like that with the technical skills that complements you, then why won't someone else see what you see that has that knowledge that you're missing, that they're telling you something by their inaction?
Yeah, excellent answer, Karl. Thank you. I think that Natalie will be back, and when she comes back, we can inform her also of that part to the answer. Helen, are you online?
Yes, I'm here.
Helen, you had a question here about something you wanted to ask about education, but I'm not sure what your question quite is. You want to
Right.
Now, just before you do, Karl, Helen has a business. She's had this up and running for a while. It's proven, and so she has some interest to ask from this standpoint. Go ahead, Helen.
Hi, I'm not sure if you can see me, Karl. Very nice to meet you. My name is Helen Hao Wang. I have incorporated a company 2 years ago, like 1.5 years ago. And what we are doing is on arts education. So art education, but on performing arts. So where we have provided musical camps, where we have 6 arts educators from Canada. And in earlier this year, in January, we went to Shanghai, Beijing, Guangzhou, Shenzhen in China to do 9 musical camps in collaboration with the musical company that's like the China Mirvish, basically. So unfortunately, the COVID-19 breakout in early January in this year. So 2/3 of the program has got canceled, and all the team returned to Canada safely. That's a good thing. And then right now we are developing a online kind of mode of class with students. We have an audience base of around 200 to 300 students in China from kindergarten, not really kindergarten, from grade 1 to grade 12, let's say, or more like grade 2 to grade 12. So my question is, like for education, I felt is like your audience isn't then like easy to scale up really quickly, especially for arts. And also this period of time is hard, very hard for art industries. So what I wonder is, like, I feel like this kind of my area, it need time to develop. Like I cannot really take like everyone knows more money will bring more opportunities in some ways, but my question is, I always think there's always 2 sides about one thing. For money, it's the same thing. So I have more money, I definitely will lose something else. So I want to know how to spend money wisely. Like we spend some time talking about how to get money, how to indicate we are low risk and we can provide value and we have customers, but how to use this money effectively to like provide service is something I really want to know more. Yeah.
Okay. So one of the things you can get with this new search technology is you can look at what are people searching for, what are trends, and with this new environment with most people remaining home,
Right.
what a lot of artists are doing is switching to broadcasting themselves over Facebook or other social media, because the gig economy that artists have always relied on is effectively shuttered by most governments. It's really, there isn't really a shortcut that you need to prove that people are searching for this. You need to prove that people are subscribing to this to attract capital. And that really, it's in some ways not too different from any other businesses. Are people, if you think about the traditional theater, are people signing up to theater tickets? Do you have season ticket holders? In the new online world, are people subscribing? Are your subscribed people inviting their friends and family to subscribe? Have you got virality working for you? Really, guerrilla warfare, low cost, almost free, word of mouth audience building.
Right.
You need to do because that's affordable, but you also need to do to get the traction ultimately and interest from investors. For example, there's a brand of yogurt that is now very popular in Canada. That particular company spent $60 million in 1 year on television advertising to create that particular brand of yogurt. No startup's going to get $60 million to do that. That's a multi-billion-dollar dairy company that could spend that kind of money, who's proven success in various other dairy products, right? But the successful startups got to have that word of mouth following and build the ability for you to invite your friends and family to the experience or to the product. Word of mouth in a digital world can be digitally tracked. You think about companies like Facebook, before they started making money off advertising, it was the model that you invited your friends. Or you think about a company like Zoom that we're using here today, the very essence of the product was, you know, Gray sent me an invitation. Now I've got Zoom on my machine. And then I sent an invitation to someone else. And that, so the virality of the product got everybody to use the product.
Right. My other question is, just now you're talking about lifestyle business is like people like start their business pursuing a good lifestyle. And then investor is majorly looking for the returns, like the business who is looking for to have a high on return on capital and scale up their business. So they want the investor to invest on their company.
No.
But what's really the purpose of scaling up? Isn't like the people who are doing the business isn't also looking for a better lifestyle? I saw that's the human nature of building something, being an entrepreneur. Like they want to have a better lifestyle in any ways.
Well,
And also
when we talk about a lifestyle business, let me qualify that better.
right.
So, you know, we can buy a little corner boutique business together and provide for both of us a pleasant lifestyle. Won't have a lot of employees, will not employ a lot of people, probably will have some impact in our immediate neighborhood because our business provides some value to that community that we are in. And maybe we employ some part-time people. And that is a business that provides a salary and income for the founders. And there's nothing wrong with that because that's 1.1 million of Canada's businesses. But 7,000 of Canada's businesses are the major employers and the major contributors to philanthropic causes. And really, you know, moving Canadian society substantially forward based on the services they offer. And there isn't, it's not an either or, they both coexist. But investors, to get the kind of returns that they want on the risk, are going to go for going to consciously understand what they're investing in. Last thing I want to do is invest my money in your business. It gives you a six-figure income and I never get my money back. Unless you're my family and it's a way of providing my kid with a job.
Right.
So thanks, Helen. Moving on from that.
Thank you.
Yeah, we do have Natalie has come back, by the way. She's managed to successfully log back on, so we'll pick up on that in just a second. Just to clarify and part to your answer, to make sure that everybody understands, an investor when they, and so I'm going to frame it as a question to you, Karl. An investor when they invest, and there's a certain multiplier in terms of what they're looking for back, it tends to be of what factor, right? So what would you say?
If you think about seed investing, the highest risk form of investing, for every $1 invested, you're looking for $40 back in 5 to 7 years. Why such outsized returns? Because if you look at the statistics, for every 30 investments you make, one of them will give you the 40x return. The other 39 won't. 80% will give you your money back, but not a return. 20% will be outright failures. You lose your capital on 20%. You get your capital back on 80%. So you're reliant on the 1% of the top 20% for the real return on capital. It's a very, very risky endeavor. So you go into everything looking for a 40x return on your investment. And even after all your due diligence and all your work, historically, the people that have been doing this since the 80s, and there's data to support it, it's the 80-20 principle still comes through, and you're only going to get that one outsized investment on a very small group of investments.
Thank you. Natalie, are you still with us?
Yes, I'm.
Oh, there we are. Okay. So Karl had answered your question, but just, Karl, if you don't mind repeating, you recall.
The clarifying question, Natalie, is in your business, who, in addition to yourself, are the founders of your business?
So the founders right now are me and my brother who's in computer science. And we got one other computer science graduate student to work on this. He said he doesn't have the experience to do back-end development, but he can do like user-face design and like sort of like helping us with presenting to hospitals. And I've talked to 2 physicians. They haven't fully, I wouldn't say that they are fully signed on because they haven't seen how it works as well. So that's sort of where they're at. It's like, okay, well, this is a great idea. How would we test it? When you develop this, we would be happy to test this. But I haven't found money to like hire an AI person, or even when I go to U of T's like computer science department, I can try contacting students, but that's sort of what I'm doing, just like on hand, searching for people. And I feel stuck about the next steps.
Yeah, so I think some of the stuff that I say is not, it's not meant to rain on your parade. It's just to help you get to where you want to get as quickly. You need to find somebody that has the expertise that your current team doesn't possess, who is enamored and as excited about your idea as you guys are, and is willing to throw their lot in with you and become a co-founder. If you can't convince the expert that you need that isn't on your team to round out the team that you've got, you got to keep asking yourself, why can't I find an expert that's willing to commit and believe in this as much as me and the other co-founders?
Okay.
The healthcare answer is a very good answer. Everybody will tell you that. Well, come back to me with a sample, and then let me try it.
Right.
So,
Practical.
what else would they diplomatically say to you?
Definitely. I think we were looking to see.
If I came to you with my idea and you said, well, Karl, that really sucks, that's stupid, then I'd go like, okay, I get it.
Mm-hmm.
But the worst answer is, come back to me and I'll try it, because it gives me a hope that you like what I'm doing. But you're saying, I haven't decided I like it yet, but I'll try it.
Mm-hmm. Yeah. So I guess we'll keep focusing on finding AI talent that we can pitch this to.
Talent that's, as you know, like for example, this other AI company I talked about, there's 2 AI individuals who needed to find a CEO because they knew they had the AI knowledge, but they didn't have a CEO for their business.
Okay.
So every team, it's a little different, but you need to have that expertise. Like initially, the lowest cost way is founders investing their sweat equity.
Right. Okay. I'll work on that. Thank you.
Thanks, Natalie. That was a great answer, Karl. Thanks. I think it is relevant to a lot of folks who are early on and are going through exactly looking for others to join that team to make it as strong as possible. We do have, Mo, are you still here?
Yes, I am.
You're next up. And now, just to introduce Mo a bit, Mo has recently pivoted into an idea and is very anxious to be working on this. And yeah, so go Mo, you're all set.
Yeah, so hi, Carl. Thank you so much for your time today. Just to elaborate, my idea is based in the health sector and specifically in supplying medical equipment. Now, given the whole nature of COVID-19, I've sort of pivoted because my idea was embedded in import-export. So I pivoted towards this currently, and I was just wondering. I'm trying to get an idea of the landscape of angel investing for the healthcare sector. Now, if you have any experience in investing in any healthcare ideas, startups, and if so, if you could just elaborate on your experiences, like what did you learn from those experiences, if any?
Okay. It's a really interesting. So I'm involved in a software as a service business that is has its original roots in strategic outsourcing for Canadian industrial designers, engineers, product people needing to connect to factories around the world. They have developed a software as a service platform for small and medium-sized Canadian manufacturers to connect not just to the factories, but to manage the whole workflow in the process. And we're scaling, we're building that business out. Mm-hmm. In March, when the pandemic hit, we said, well, what can we do to make a difference? Well, we have these deep, decade-long established relationships with offshore manufacturers that are already manufacturing all the things that the world needs. So we set up we took a month off, set up a whole new business that effectively provides PPE to anyone that goes to the website and orders it in large quantities. So that kind of is an interesting pivot. That's now up and running. It's kind of fully automated. It's doing a few $1 million a week. In business, and the cash flow off of that business is we're using that to help fund back to our original idea. Because we do think that ultimately there's going to be way too many non-differentiated providers of basic PPE. As you know, there's only one factory that provides the raw material out in Nanaimo for face masks that make the N95 or the standard. Yeah. The assembly, you hear all kinds of stories about all sorts of people starting to create PPE. Yep. So how are you going to differentiate? How are you going to be first to market? How are you going to differentiate? How are you going to have something that's defendable and scalable? Right? One of my other partners has been trying to get his PPE business off the ground since March. He's getting stuck in government bureaucracy. Meanwhile, our guys set it up, launched it, and it kind of runs itself. So I still think, though, there's opportunities in PPE. Mm-hmm. But you need to find the need that other people sometimes a not immediately obvious segment to start your business in. Mm-hmm. My experience with healthcare, I know absolutely nothing about healthcare. I mean, I financed healthcare. I financed all sorts of elective medical procedures. Mm-hmm. But then in March, took what was effectively a manufacturing outsource business and set up a healthcare business overnight. Oh, okay. In terms of, I'm just going to do one follow-up question in terms of that. When you pivoted, what were some of the things that you took into consideration? If you can elaborate those, what were some of the things you would say were sort of like, I wouldn't say blockades, but they were sort of like a hurdle that you had to cross over, and you kind of found a tough time getting over that hurdle? Effectively, we knew who needed the product, and we knew where the product was, and we're a middle intermediary. Yes. Okay. So the problem was capital to facilitate that. Oh,
Okay.
Right?
Okay.
So, like, if you go to our website, we'll sell you PPE, but it's 50,000 pieces at once,
Right.
or
Well,
10,000 pieces. Like, it's large quantities set up for governments and industrial applications.
okay.
You're buying large quantities of this product.
Hmm.
So, so A, we need to get paid in advance
Okay.
because our factories need to be paid in advance. Because if
Okay.
we don't pay in advance, what happens right now is where the factories are located, there are people literally waiting for product to come off the belt and will pay cash on the spot for it right now. It's an extremely overheated market.
Yep. Yep.
Yeah, and you've heard stories in the news about government orders being diverted by other governments willing to pay 3 times or 5 times as much for the goods.
Yes, I have. Well, thank you so much for the elaboration. That helped a lot, and thank you so much for your time overall as well.
But I think there is an opportunity in this product. It's just, I think everybody, right now, people are taking the low-hanging fruit.
Mm-hmm.
You know, what does the world look like? This becomes as common to wear as socks.
Right.
Thanks, Mo.
Yep.
And yeah, bigger orders can lead to bigger mistakes. So there's always that, the risk kind of gets bigger too as things go with that. So in terms of things, Roberts, are you still here?
Yes, I'm here.
You have a great next question here. You want to ask your question?
Yeah. Hi, Carl. Thank you. As everyone has said that previously, thank you for being here and sharing your experience in these matters. And my question would be exactly about your experience with different startups and founders, because during the years you have seen a lot of companies successful and maybe not that successful. And if there is that some common things that you've seen the companies that have failed, what would be that thing?
To be successful, you need to be constantly learning organization and organism. So you as an individual, I as an individual, need to keep on learning. That's ultimately what's you're going to allow you to adapt.
Mm-hmm.
And we find I've had failures with companies where I failed to observe and learn. I've also had conversations with founders that said, I appreciate all the coaching and mentoring. It's been really good, but I haven't done anything that you suggested and I'm running out of money. So I think I'll just pause.
Mm-hmm.
And I think the sort of the answer in there, not executing, yeah, it was good ideas, but I didn't do any of it.
Yeah.
Or I didn't even try any of it.
Yeah, makes sense. And not even a follow-up, it's maybe a different question. So right now, as we know, it's a crazy time that we are living in. And then right now, if you would be starting a company, what would be a suggestion you'd give yourself?
Well, I am always. And that is this a nice to have or a need to have?
Yeah.
And further than that, if it's a need to have, is it a need to have without consequences?
Mm-hmm.
So think about that. Are we selling vitamins? Are we selling painkillers? Obviously, painkillers are in more demand than vitamins.
Mm-hmm.
And is it a painkiller without any side effects?
Mm-hmm.
Right? So in this current environment, I think sometimes it helps in my mind to assume that whatever the terrible state of the environment is permanent. Mm-hmm. Only because then it allows my mind to focus on, if this was permanent, what would I be doing more of? What would I be doing less of? Mm-hmm. And if things turn out to not be like this and things go back to in February, that would not undermine my business because I assume that I'm going to be successful in this environment.
Mm-hmm. Yeah, thank you.
Unmute myself here. So thanks there, Robert. And thanks, Carl. We do have a follow-up here from, I think, Pratik, you're next. If I have this, oh no, sorry. I skipped here. Oh no, I didn't. Pratik, are you here? Hello?
Hello, it might be muted.
Yeah, he might. Pratik?
Hey, Grace. Sorry, I'm here.
Yeah, that's fine. So you started saying that you had 2 questions.
And then I had a third. And thank you, Karl, for yeah, thank you, Karl, for taking the time. I had a couple questions, but I'll just start with the most recent one I had, because I think there was a topic of equity there. But I've heard that an equitable division of founders' equity doesn't always mean equal in a startup. For example, like a 50-50 split between 2 founders. I was curious to hear your thoughts about what you think is an ideal division of equity between founding teams from an investor's perspective. And is this like, would you prefer to see potential startups that you're considering for investment having a lead founder that holds the majority of the equity, or is some other type of division okay with you?
Yeah, we're not looking for equality. We're looking for meritocracy.
Right. Got it. Okay.
That doesn't mean that your culture isn't. Your culture should be egalitarian. However, this is it's a meritocracy.
Right. That makes sense. So you'd probably want like a division where the founder that's leading the charge probably holds the majority of the equity.
Well, it's the founders themselves need to negotiate that amongst themselves before they come to investors. Like, we don't want to get involved in your family squabbles.
Right.
So part of that is when founders first come together, recognizing each other's value and negotiating something that works for everyone. There's a great book by the co-founder of Microsoft.
Mm-hmm.
He was 2 years senior to the person that we all see as the sole founder of Microsoft. He was 16 and Bill Gates was 14. And initially they started out, he was the senior partner. And over time they became equal partners. And over time, the younger, Bill Gates, became the more senior partner. So that is an ever-changing dynamic in the business.
Okay, understood. Just a quick follow-up on that is if you come across a startup that has some of these other strong factors that you mentioned, such as revenue and track record of a founding team, but for whatever reason, if the split between equity wasn't ideal, if they did a very simple let's say 33% split between 3 founders, is that something that would make you do a double take and then kind of wonder, or make you hesitate in terms of investing into that type of company?
No, not at all. But we would obviously, part of our due diligence, we'd find out that if there was any acrimony or some unspoken feelings around that, because we'd be concerned about retention of the founders. So we'd be concerned that one of the founders feels they're not being equitably treated and they depart there. How critical is that to the business?
Right. No, I understand, because all each of them may not have been contributing equally, and then even though the equity was split like that. And thank you for that answer. I'm just going to finish up with one last question. You mentioned two very important factors when you look at a potential company. One was revenue, and then the other was the founder or the founding team's track record. I was wondering if one of these factors, from your perspective, always takes precedence over the other, or is this always flexible based on the particular situation and particular business?
The foundation of the business are the founders. So we will go with a B idea and an A execution, and the execution relies on the founders. Right? Like if I had a really bad idea, but I was really successful with it, that's more important than an amazing idea that I could never get off the ground.
Got it. Okay. Yeah, that makes sense. Okay, and thank you very much for answering my questions.
Thanks, Pratik, on that. And thanks, Karl, for the answers on that. I have put a time limit on questions, by the way, so they won't go on forever. There's a cutoff in 3 minutes, and I'm just saying that so people can hear if they haven't seen that in chat.
And we can explore doing this again, or doing this,
sure,
find out, or a deeper dive, or some other way. See how people feel about what we did today.
Well, thank you very much. Siobhan, you still here?
Of course I'm still here.
I have no idea what Siobhan's question is. He only said, I have a question. So, Siobhan,
nice
let me introduce just a second. So, Siobhan has a thriving business. He has sales. He's in the cosmetic industry. He does natural cosmetics. So, Siobhan, over to you.
Hi, Karl. Nice to talk to you again.
Nice to meet you again.
All right. So pretty much
we talked about last time.
Yeah, I took your advice. It worked, right? That's what I have in sales now. So pretty much what I wanted to get into is because eventually, as you said, when you have a company that wants to scale outside of just a family business or a lifestyle business, this is when they would normally want to involve an investor. I just want to elaborate more on Gray's question that he asked pertaining to what is it like to have an investor to work with. And more of directly, my question is, I want to kind of have a feeling of the both sides. What does it feel like to work with a startup as an investor, and what does it feel like what feeling does the startups give to the investor when they're working with them? Is it like there's certain expectations they didn't sign up for, or like what is it? What's the whole feeling of giving up equity to an investor?
What does it feel like for the founder to give up equity, or what does it feel like for the investor to have? It's really important that expectations be in writing, and all of that be discussed before you make a deal. There's an expression that fences make for good neighbors and contracts make for good business.
Yeah.
So sometimes things are not put in writing and expectations are not articulated, and that creates a lot of hardship later for all parties.
So I was asking more indirect in terms of the working relationship, as opposed to, or let's assume that you're my investor, right? And what is it like working with you? Like, what are some things that you expect from the founder of the company like myself apart on that agreement?
Well, it obviously depends on again, it's important to have, if it's just a single invest, there might be a shareholder agreement that's drafted that can be very boilerplate, or it can spell out what is a shareholder decision, what is a director decision, and what is a management decision. And usually there's some decisions are an all shareholder decision. Other decisions are board of directors decision, and some are within management's.
Okay.
So when I was a CEO of a company, then I'm very clear that certain things, like for example, merging my company with another company would require ultimately all the board of directors to consent and shareholders to consent. But paying
Yeah.
expenses for one of my vice presidents was well within my purview.
Yeah.
Right? So it depends on the quantum of the issue. And that usually is spelled out through some shareholder agreement, through a shareholder agreement of some kind. Also, whether that money that you're getting is coming in as equity or it's coming in as a loan. So whether it's a loan agreement without any, or it's, you know, those are all, it's two different ways to get capital, equity or debt.
Okay. All right. Hopefully I can shoot you a message on LinkedIn to continue this conversation.
I'd love to.
Thanks, Siobhan. Yeah.
All right.
And we have then, Larry, are you still online?
See you, Larry.
Yep, I'm here. How's it going? Oh.
There you are. So on this, Larry, you're the last of the folks asking questions.
Oh, excellent.
You have 3 questions at least from what you've typed.
maybe you'll answer maybe one of those questions together at one time. So,
Bring it on home. First, introduce what you're doing.
Okay, excellent.
And where you are.
Cool. Yeah. We've actually spoken before, Carl. I have a marijuana company that I run. It's a cannabis technology platform that connects users with legal local dispensaries. Obviously, that's an excellent industry to be in right now. Sales are really up, and the regulation has really eased up as a result of the situation, the COVID situation that we're in right now. I'm really interested in your financial experience as principal of a VC. I myself have a finance background. I was in investment banking for a year before I came back to school. So I actually wanted to get your perspective from an angel investor and as a principal of a VC for pre-revenue startups. How do you evaluate their financial models? I mean, I can understand how, for instance, if you're a startup generating revenue, for you to forecast for you to create a financial forecast, you can be sure to a certain extent that these people can deliver on what they're promising as a result of their previous performance, right? So for pre-revenue startups, how is it that you evaluate that?
So it's a really good question. There's a number of different ways to, as you know, imagine you worked in an analyst at a bank.
Yes.
Right? So you got to do all that lovely DCF calculations. And and you got to look at comparables.
Yes.
And so if you take a tool like Crunchbase, which gives you all the seed and startup capital raised, as an example, you could look in there to see all the like companies and what stage, what valuation did they get. Right. So what was, for example, other companies like yours on Crunchbase, what was their friends and family round valuation and range? What was the seed round valuation and range? And what stage were they at that time? You know, something that I shared with Ray, that maybe we'll share with you guys at some future date. Amazon started out the same way, right? The initial shares in Amazon valued the company at $10,000. You know, subsequent valuations were done at friends and family round, were done at the venture round before they went IPO. But you're right, you have no revenues. The DCF model doesn't work. So comparables has a lot to do with it. And there's, you know, there's also the venture capital method. A very famous angel investor called Bill Payne, who's got a method. There's a number of different methods that we would use. And ideally what you do is you might take 4 or 5 different methods, apply them to your business.
Yep.
And what you get is kind of no different than if you're working at the iBank. You guys would take a DCF valuation, it gives you a range.
Yep.
And then you do a comparables and it gives you another range, and maybe, and then you go in between those, and you're never giving really your company's worth X. You're saying your company's worth between X and Y,
Right.
based on 2 or 3 different methodologies. So it's the same, very similar exercise from startups.
That's a really good point, especially on the comparables. And as I was going to say, you segued perfectly into my next question regarding comparables. In industries where you have very little data to go off of, how do you make good comparables? For instance, the way that we're doing it right now, and I really do want your advice here on whether we're doing it right, because our model right now doesn't have a lot of, well, the market in general doesn't have a lot of data for us to create what I guess a classic VC would consider an ironclad model, right? So those comparables that we do are to services who are similar to ours in other industries. So we do cross-industry comparables. How do you make those comparables meaningful in a model? So for example, if I'm in the marijuana industry and I'm running a pickup app, can I do a comparison to a pickup app in the food industry, for example?
One of many. For example, it sounds like, you familiar with Pineapple Express?
Yes.
Right. So that company transacted recently. So, what was that? What were they valued at, as an example, right? And then other players like that around the world, because often in this particular case, there might be somebody doing the same thing in Switzerland or the Netherlands or US states or other places where cannabis distribution is legal, right? So those are all, any of that kind of data you can bring in. But yes, like Pineapple Express has now moved into liquor distribution, as an example, right? There's a whole other set of, because Foodora is getting out of that in Ontario. So you've got different apps that are providing a similar service.
Service, yes.
Right. It's the service ultimately that you're providing, not the app that's going to drive your value, because your software is the enabler. The service is your differentiator.
Okay, understood. Perfect.
So Larry, Pratik has a follow-up actually to one of the questions that I think that you're asking here.
Uh-huh.
So if you don't mind, Pratik, you have something to ask? I'll take him a second to get unmuted.
Oh, sorry about that. And Gray, it was actually a question just in regards to what Karl mentioned early on about lifestyle businesses, and you mentioned a figure. I think it was somewhere around 5 or 10 million, and that's the typical scale of a single proprietor business that just scales based on cash flow. I was just curious to hear your thoughts, maybe not so much as an investor, but maybe more so as an entrepreneur. What are your thoughts on advising young entrepreneurs and when they're kind of considering both paths to take, and even in terms of the size of their idea? I know there's some that are considering doing larger platforms, and they want to go for that 100 million valuation or more, and there's some that are happy with doing scaling based on their cash flow or loans to that 5 or 10 million mark. But maybe later on they'll still be able to either sell their initial businesses for a decent multiple, and then maybe try and execute on those larger ideas. Do you think that there's a smarter way to go about it, or and what would you do if you were a young entrepreneur kind of deciding between those two paths?
Well, there's a lot more to your situation that you need to really understand. What's your own personal purpose and mission, values. You need to be clear on that for yourself, and so getting to know yourself, self-knowledge is very important. The smaller business or the larger business starts out as a smaller business. So to get to be the larger business, you first need to be a successful smaller business. It's not that the smaller business operates differently than the larger business when they're both small. Does that make any sense?
Yeah, I think somewhat, and I think the key difference is it would it be like the willingness of the founder to you know, take outside capital and scale faster, especially if he has an idea that's, you know, defensible and unique.
Well, what also happens is if you don't take capital, but the idea is great, other entrepreneurs will copy you. And they'll say, this is an amazing idea. I was in Toronto. This guy's got this great business, but he doesn't want to take it to Quebec, or he doesn't want to take it to the rest of Canada, or he doesn't want to take it to North America. So all we're going to do is going to copy his business and do the same thing. That's a free market economy. That's competition, right? So if you've got a better mousetrap and you're not willing to scale it, and you're leaving that rest of the market unserved, that another entrepreneur will do that.
Right. Got it. Yeah. Thank you for that. I think that leaves me with something to think about.
Like if you go back to the cannabis industry for a second, tremendous amount of capital went into the cannabis industry. All sorts of players arrived in the cannabis space in all different parts of the value chain in Canada.
Yeah.
In doing all different bits and pieces of something in the value chain, but at certain parts in the value chain, there's oversupply.
Certainly. Yeah.
Right? Because more people were chasing the market than the market could consume.
Yeah, exactly.
Certain segments of the value chain. That's just the most recent one. And you'll see that, right? You're going to see that with PPE. Right? You know, it's kind of like the gold rush, right? Everybody rushed to the Yukon to harvest gold.
Or pivot into that space and then pivot back, like the company that you're working with.
Yeah. You know, that was just, to me, we clearly saw that not as a new thing that we're going to do forever. That was a short-term thing. We're going to be opportunistic, leverage our assets quickly, and in 30 days get back to what we really were all about.
Can you share on their name?
Yeah, I can send people the link after if you like.
Okay.
We accept all major credit cards.
Okay. I have one from Bolivia. Will that one be okay? So, Karl, I want to thank you very much for today. And we have come to that point. It's amazing that an hour and a half goes by that quickly, right? But it's just absolutely sailed. So it's been very informative. It's been great. Lots of questions. Everybody's been with us from start to end here. So I'm sure I speak for everyone when I say, you know, thank you for spending your time, giving us your insight, your advice in terms of the approach to investors and all of that. Very, very welcome, something that everybody here needs to know. And I've been very happy that they've come to spend some time here with you. I think it's a really wonderful thing. This is a part where I usually take you now out for dinner or something, right? So when this is all over, I owe you that. We have to go out for getting a bite to eat somewhere. And all of that, well, all of that too. Any questions you had, Karl, before I sign off and stuff?
Yeah, I'm wondering afterwards, not now, but please share with Gray what we could do better, what we could do different, how I could improve and make this more valuable if we were to do this again. Is there interest in, these are all questions that don't need answers right now. Is there interest in going deeper and wider into all of the things we touched? We really were superficial in a lot of these things.
That's right.
Just the surface. You know, is the time about right? Does the attention start to wane? Should the, you know, all those, how could we, if people want to have more of this, how could we do that? And if people want to have less of something, let us know too. How can we make this more effective going forward, if we in fact decide that we should go forward?
the folks that are here today represent a fairly big swath. So we have folks here that are fairly well along, some that are less well along. And it's been great as an introduction that's given a taste of it all. I'm sure there are some among us who are at that point where they're definitely anxious for more. And we sense that with some of the details on the questions that have come forward, particularly questions that are very specific about, aspects of how do we work this part together? How do we look at, the detailed questions that have come forward. So on that, I want to thank you. We'll definitely follow up. If people have ideas about wanting to work more with Karl and learn more about this, let me know. Send me an email about that, and we can certainly take that up. In terms of, this is the hardest part, Karl. The hardest part is where you take what we've created here and you press the end meeting and everything kind of like disappears. It no longer exists. Right? This is the hard part because right now we're here, we're together. There's something that exists here. Right? We're all living and breathing in this space. And as soon as I hit that button, all the pixels just explode and it no longer quite exists. But thank you very much. It's been wonderful. You've been a great guest, and we'll be following up soon.
Great. Enjoy your evening, everybody. Thank you for letting me drone on like this.
Most enjoyed. Thank you. Bye-bye.
Bye.